What's up guys, it's Donny here. Today I'm going to give you a crash course on the stock market because it really sucks knowing that your friends and family don't use it to their full advantage. The stock market is one of the best wealth building sources out there, especially in today's world where you can just get your phone, download an app, put in some information and invest. It's so easy. So today I'm going to talk over 3 points. What the stock market is, potential risks and downsides, and why you should invest anyway, and how to invest. So this is the stock market. This is Tesla, a new company that wants to make money by going public. These are shares of their company. They want to raise money by selling shares of their company. So they go through all the legal stuff and IPO or initial public offering day comes. Based on a bunch of factors, a price is set. They start selling shares by making them available in the open market. Most of these shares are gobbled up by big investors. But a portion is still open for retail investors like you and I. This is how a company makes money in the stock market. When they sell their shares, people buy them and they receive the profit from selling those shares. Now, they can't make any more money with the stocks being sold back and forth between other investors because they're not the ones selling them. They do have a few options though. The first option is for them to sell more of their stock, in which case they would lose that stock, which is control of their company, and the people in the stock market that hold their shares have a little more control of their company. But as long as they maintain at least 50%, they should be okay. Another option they have is called share dilution, in which case they add more shares available in the stock market. And then they add that to the stock market. In effect, the people who currently own their shares have less control of the company because the shares have been diluted. But there's more shares to sell, to buy. So how do the prices of stocks go up and down? Well, that's based on demand. If there's a lot of demand and people are trying to buy the stock because the company is really doing well, then the price goes up because the people willing to sell are very few. But if there's a lot of supply in the market and there's few people who want to buy the stock, then the price goes down because there's little demand. So it's basic supply and demand. So what are the potential risks and downsides of investing in the stock market? Well, you could lose your money. Yeah, I'm not going to lie about that. There could be fraudulent companies, companies trying to scam people of their money. Think Enron back in the day, or today, Nikola, right? Or a company could simply go bankrupt, like Hertz. This year, because of the pandemic, it hurt them. They had to bankrupt. There could also be a market crash, like in 2008, the real estate market crash, or a correction. Both cases, investors, both fund managers and retail investors alike, basically panicked, started selling it like crazy, and then prices dropped and everyone lost a lot of money. But remember, you still own the stock if it's a crash like that. So why invest in stocks with all these risks? Well, remember, fraudulent companies are few and far in between. And it's really easy to insulate yourself from the risk of losing your money by diversifying your portfolio. And what I mean by that is not to put all your money in one stock, but into several stocks in different fields, such as entertainment, tech, food services, transportation, stuff like that. And remember that the stock market trends upwards overall about 8% per year, and that's including all of those crashes and corrections. An easy way to mitigate your risk is by investing in ETFs, or exchange-traded funds. What those are basically baskets of companies, where if you buy a single stock of that ETF, you will get a fraction of every single company in that basket. The S&P 500 is an index of the top 500 companies, large companies that have proven track records, and there are several ETFs that follow that index, such as VOO and SPY. Those are very good stocks to invest in if you have no experience, or if you just want to invest in the stock market as a whole to grow your nest egg, to grow your net worth. Now, there are two types of stocks that I like to invest in for our long-term investment strategy. The first one is growth stocks. these are companies that still have room to grow. So they like to invest in themselves to make sure that they continue to grow. And in effect, the stock raises in value. Then this is great for growing your wealth and net worth. The gains are not taxed until you sell the stock. On the other stock that I like to get are dividend stocks. And those are for companies that are so large that they really don't have much room to grow. So they end up paying some of their profit to their stockholders as a reward. Now, I prefer growth stocks because dividend stocks, when you get paid that dividend, those are taxed as income. So even if you reinvest that, which is a very valid strategy, everyone does it, you're getting taxed. If you do decide to invest in single stocks, make sure to do your research and invest in what you know. I myself invested in AMD when they were $13 because I thought the Ryzen processor would do really well. Right now it's at $80 and I 5-6x'd my investment in that one. Also keep in mind, there are some forums out there and people who are going to say, hey, jump on this bandwagon for these penny stocks because they're going to explode, go to the moon. You're gonna 5,000x your $1 bill into $5,000. That's, for me, that's gambling. Most of these penny stocks, they crash and burn more often than not. It's kind of like playing the lottery. Honestly, if you're gonna do that, use your throwaway money. Assume you're not gonna get that money back because you probably won't. So how do we invest in the stock market? Well, generally, I would first tell you to check with your employer, see if they offer a stock market-based retirement account like a 401k, especially if they match your contributions. Max that out every time you can because the ROI on that, the return on investment, is crazy. If they match it at 100%, you're doubling your money just like that, and we're not even counting the gains from the stock market. If you don't have one through your employer, I would suggest opening up an IRA. That's an individual retirement account. There are two types of those. One is the traditional IRA account, and the other one is a Roth IRA. So those are taxed in different ways, but they're generally the same thing. There's a lot of videos out there. I might make one in the future. Just look it up real quick. It's basically the traditional IRA is taxed at the end and the Roth IRA is taxed at the beginning. So it depends what you think the tax will be in the future. So what if we've already taken care of our retirement account? That's already squared off, or you're not even interested in a retirement account. You want to put your money in the stock market for a shorter time, maybe 5, 10, or 15 years, let it appreciate over that time, take it out and treat yourself. We can totally do that. There are 4 apps that I use all the time. Robinhood is the one that introduced me and the one I use most to this day. It's also the one that most people use as novice investors. It's because it's so easy to use. You just download the app, you put in your information, and you start investing. The second one I like to use is Webull. It's basically a high-powered version of Robinhood. There are so many options in there, but it can get overwhelming. So I would suggest starting with Robinhood. A third one I like to use is M1 Finance. In that app, that broker lets you make your own pie, which is basically making your own ETF. So in this pie, you put in all of the companies, all of the stocks you want to use, and you adjust the size of the slices. So my biggest holding is Tesla. I'm very bull on Tesla. I would make that maybe 25% of the pie, and then the rest maybe 5, 10, or 1 or 2%, depending on how many companies are in there, to make that whole 100% pie. And then you can just invest dollar amounts, I think in increments of 100 or 50, something like that, and invest in that whole pie as if it's your own specially made ETF. And it's pretty great. So the fourth and final app I'd like to recommend to you is Acorns. It's a very simple to use app. You put in your money monthly, $1, $3, $5, very small amounts if you want to. You can also use bigger amounts into these expert-made portfolios. You sit back, relax, and watch your money grow. So if you're ready to let your money grow in the stock market, get a free stock through Robinhood with the link down below. Then get 4 free stocks through Webull, worth a minimum $22 and up to a total of $3,700 between the 4 stocks when you deposit $100 or more. That's at least an instant 22% ROI. Please keep in mind, I am not a financial advisor. I don't have any licenses or anything like that. This is just my perspective. And I also have no sponsorships with any of the apps that I just mentioned. I just like to use them. And there you have it, your crash course in the stock market. Don't be afraid to invest. Do your research for single stocks if you're going to do that, or just invest in ETFs, or do both. That's what I do. I have a lot of money in both ETFs and single stocks. The main important thing to remember is to invest in the long run. Anything you sell within a 1-year period from buying it will be taxed as if it's your regular income. So keep that in mind. Invest in the long run, 5, 10, 15 years, and the stock will go up almost guaranteed. If you enjoyed this video, please give me a like. Really appreciate it. Subscribe if you'd like to see any more videos, and we'll see you next time. Thank you so much.